Hello and welcome to BQ Pramam Hiraldaria. Joining us on the show today is Pankaj Pandey, Head of Research, ICICIdirect, joining in. Welcome to the show, Pankaj. A lot of movers and shakers in trade today.
Yeah, hi, good morning.
Uh, Pankaj, let's start off with an HUL. Clearly, if you see in terms of the numbers that have been reported, they've beat street estimates overall. They've gone ahead and hiked the royalty payment to parent as well. Though the rural business slowdown has continued. What do you make of it overall?
So when we sort of look at HUL numbers, largely it was in line with our estimates, both on the operating front as well as on the earning front as well. Now, this 16% kind of a revenue growth is largely driven by pricing of 11% and volume growth of 5%. But our sense is that when we sort of look at going forward, since some of the commodities have corrected, so volume growth is where we would expect a larger pickup to happen. And also the pricing growth will sort of taper off. So you'll see a better growth template sort of panning out. And margin wise, we have seen gross margins, while they have contracted both gross and as well as EBITDA margins on a YY basis. But quarter on quarter basis, we have seen an improvement. So that's a sort of healthy sign. I think the commentary on the rural market is also positive in terms of better volume growth ahead. But I think the challenge always has been that when you see the stock sort of declining today because of the royalty increase. Now, our calculation says is that the impact on earnings because of this royalty increase would be the tune of about 2.5% for FY24 and about 3.3 odd percent for FY25. So, and I think that is the kind of a price impact what we have seen. Overall, this stock is obviously trades at a pretty expensive multiple of about 60 times FY24. And which is why we are sort of maintaining a hold rating on the stock with a target price of 2,800. So this royalty is not really sort of happening in a good taste, and despite overall decent set of numbers. And FMCG as a category is the valuations are on a richer side compared to you see a lot of other market sectors. And which is why structurally we are not positive for most of these companies, because while the earnings growth could be low double digits, but the high P multiples may sort of limit the outperformance compared to Nifty.
Right. So would you advise an investor to enter the stock at current levels, or from a valuation perspective, it's still expensive?
So, say all these stocks have done well, largely because when the growth opportunities were limited or were restricted to few sectors. Now, if you look at a lot of other sectors have started looking attractive, so which is why I would not suggest fresh into stock like HUL at current point in time.
Right. Moving on to a Sun Pharma now. They've agreed to buy Concert Pharmaceuticals for $576 million. What do you make of this acquisition? Because do you think it's something which will actually help them get into an entry into an additional portfolio? And do you think it's an accretive one?
So when you sort of look at this acquisition, the size is quite big, and while this company is a late stage biotechnology company, we would expect their products to sort of come out going forward, and the kind of target segment what they are looking at for the drug is 2.5% of the US population. But the challenge is that so while when you sort of look at Sun Pharma's balance sheet, they have a cash of about $1.6 billion. So from acquisition point, it does not it is not going to have much of an impact. But I think the challenge always lies is that besides this funding implication, this deal looks a bit of a risky proposition, given the fact that you have uncertainties on the approval, acceptance, and also the success factor, which are front loaded. So from that perspective, we are slightly cautious. Previously, we have been positive on Sun Pharma largely because the specialty portfolio in US was expected to sort of deliver good. Last quarter also the growth was good. We are expecting a better margin profile, but while they will utilize their team to sort of market this company's product, but given the size of acquisition and we are still sort of not very sure how things would sort of pan out. We are still working with the numbers. Previously, we were positive. I'm not too sure whether we'll remain positive or not.
Right. So would it be right to say that right now at current levels, at the current juncture, probably it would be best avoid till something more emerges out of it?
Absolutely, absolutely. Because previously we were looking at for Sun Pharma about revenue growth of about 11.5%, profit growth of say 13 odd percent, and the US has been sort of doing well. Now this changes a lot in terms of the kind of size what they have taken, and we still don't know how what kind of pricing and what kind of revenues they will be able to sort of generate. Which is why we are sort of a bit cautious. And investors ideally should sort of remain cautious until further clarity emerges in this particular stock.
Right. So moving from there on, another counter that we are focusing on specifically from the IT space, two of them, Emphasis as well as Coforge that has reported numbers. Now, both of them are seeing a different reaction in trade today as well. Emphasis, yes, there is weakness. However, Coforge has increased up their guidance as well. What do you make of these two stocks and what would your view be?
So Coforge, earlier also we had a buy rating on the stock. I think this was one of the few companies which was confident of delivering double-digit growth. And in this particular quarter, they've increased the revenue guidance from 20% to 22 odd percent. Overall numbers and order intake has been pretty good. And I think margin guidance also has been maintained at 18.5 to 19 odd percent. Now, the company's performance continues to be pretty strong despite the furlough impact what we have seen in some of the banking and the insurance space. And our sense is that with this kind of a guidance, what we are expecting is, or what it implies is that about 3 to 4% kind of a quarter-on-quarter growth in Q4, which we feel should not be a challenge because BFSI got impacted in this particular quarter because of furlough impact. So, which is what they will recoup. I think attrition for this company has been one of the least worries. So from that perspective, we are expecting even margin levers to sort of play out in terms of margin expansion. So we are bullish on the prospects of this company. Contrary to that, when you sort of look at Emphasis, I think the Emphasis numbers are soft because you are seeing a decline of nearly 3% quarter on quarter, and largely because we all know that the US Fed has been on a rate hiking spree, and mortgage as a business is a significant business for this company, and we have seen this business getting impacted by a ramp down in the mortgage line of business due to higher interest rate. I think next 2-3 quarters also we are still not sure how the Fed trajectory is going to pan out, and which is what the management of this company also highlighted. So they are also not too sure in terms of how things will pan out, and they are expecting pain to sort of continue for the next 2-3 quarters. We had a previously hold rating on the stock. I don't think that is going to change given the fact that they are sort of witnessing pain in one of the core areas. So from that perspective, this stock will continue to remain hold. It does not look like it is going to outperform the market for the next 2-3 quarters. Compared to that, Coforge numbers look good from most of the fronts.
Right. And overall, a quick take, Pankaj, with regards to IT as a sector, because clearly the expectation was that we could see some bit of fears that would come in. But the way the numbers have panned out for the sector, it's been much above what the street was estimating as well, right? So do you think we still need to worry for the sector if someone wants to look at making an entry? Or do you think it's still a wait and watch, probably for another quarter? Hear the management commentary at the end of the fourth quarter, and that's when start nibbling into it.
So actually, we were slightly cautious when we sort of entered the earnings season, largely because the only lever which we thought will sort of play out is a bit of a margin expansion because of an expectation that the attrition for most of the companies will sort of come down. I think overall dollar revenue growth for most of the companies has been better for most of the tier ones. So that is sort of a positive surprise. The other thing was the deal gains for some of the companies have been pretty good. I think something like Persistent is also witnessing a decent amount of price hikes also, and they're not experiencing any kind of a challenge in most of their verticals. I think some companies highlighted Europe as a challenge, that is still a sort of a pain area. But overall, when you sort of look at from a revenue growth perspective, also from the margin perspective and the deal wins, I think all of that suggests that the IT as a sector has sort of turned around a corner. While the US Fed might maintain a hawkish stance and we might see some bit of a mild recession in US, but I think overall the commentary suggests that not much damage is done to the overall IT spending, specifically for Indian IT companies. I think the other positive, especially for tier one companies, is the vendor consolidation. I think something which Chiltech and Infosys, both of them have sort of alluded to the fact that they would be a beneficiary of vendor consolidation. So I think, except for specific cases, in general, we have rated most of the IT stocks as buy, and I think going forward, things will probably look better for most of the IT companies. So from that perspective, yes, it's a sort of a turnaround quarter for IT as a overall pack.
Right. Moving on from the consumption space, Asian Paints as well. Now, the stock is extending losses as the third quarter has missed estimates. Analysts are pegging competition, capex as headwinds. But clearly, if you go to see, there was a lot of noise in the third quarter due to prolonged monsoon, early Diwali, correction in raw material prices, and a strong base quarter. Do you think there are structural factors in place which could probably indicate that the P multiples could undergo a structural correction from here on, and there could be triggers for the future?
I think P multiples in general for high value stocks are undergoing a correction. I mean, be it HUL, be it Asian Paints, or be it Avenue Supermarts, or a number of other names. Now, the challenge is that when these stocks are priced for perfection, any kind of a slip up in growth or in the outlook obviously poses a challenge, and Asian Paint is no sort of different from that. Now, this particular quarter, we've seen a zero volume growth, which is perfectly fine, given the fact that last year you had seen a 18% kind of a volume growth. We have seen margin recovery also happening on a quarter-on-quarter basis, given the fact that the raw material prices have come down. So, and also the management commentary is quite decent in terms of double-digit volume growth guidance along with new product and launches. Now, say for example, in the month of December also, they've said that the volume growth has been in double digits. But the challenge lies largely on the outlook, because now the company has announced further capex of about 2,000 odd crores, and this is over and above the 6,000 plus odd crore kind of a capex which they're announced. So they're expanding their capacity by 60%. Now, we all know that the competition in this space is sort of heating up. There's a decent amount of capex announced by a number of players. Now, what this does is that this obviously could have an impact either on the margins or on the capacity utilization going forward, which means that structurally the ROAS for this sector sort of could come down, and which is why our sense is that the P multiple, so this stock is already sort of trading at about 60 times. And which is why we are sort of structurally worried that probably these high multiples may not be sustained, and which is why we've maintained a sort of a hold rating. So we have turned cautious on this entire pack, given the fact that too many players are sort of entering, which can create pricing pressure both in terms of margins and also in terms of lower ROAS also.
Right. So overall, would it still be an avoid at current levels?
So we would not sort of suggest people to sort of buy at current levels. I think it is better to sort of wait it out for some quarters in terms of let's see how the competition is shaping up. Also, on the pricing perspective, if the industry starts competing on prices, then I think the outlook will get worrisome, because while they could still deliver double-digit growth, but the challenge is that margins, which used to be very healthy, about 20% plus, I think that could be a challenge to sort of maintain going forward. And if that is the perspective, then P multiples also will also get challenged. So I think one needs to be cautious, not really sort of do bottom fishing at current levels.
Right. So that's the view coming in overall in terms of the movers and shakers and newsmakers in trade today. Thank you, Pankaj, so much for joining us on the show and sharing your views for the investors. Thank you. Stay safe and speak to you soon again.
Thank you so much.